Welcome to the Corporate Finance course. My name is Manuel Goudie, and I will be your professor over the next 2 terms. I don't want to bore you with my background. This you can look up in the course section of the CEPADE webpage. Suffice to say is that coming from a business and financial background, my approach is a very practical one. During the course, we will be covering the most fundamental theories and concepts of corporate finance, but we will focus more specifically on those that are more frequently used and applied by practitioners every day in the real life. And we will cement our learning process through the extensive use of examples, cases, and problems. So, what is corporate finance? As you will see, corporate finance encompasses all financing, not just financial decisions made by companies every day, anywhere in the world, in the pursuit of the ultimate goal of maximizing shareholder value. Sounds simple, no? Let me expand a little bit more on this. Essentially, corporate finance encompasses or is concerned with 3 major types of decisions. Capital budgeting decisions, also called capital expenditure or CapEx decisions. Any firm, whatever its size, its location, its activity, will be investing in assets. And depending on the specific activity of the firm, a portion of these assets will be of a long-term nature and will be impacting the company over several years. With respect to these investments, key issues that we will need to cover are: what are the costs? What are how to value them? What are the cash flows these investments generate? What are the risks? What are the returns? What is the investment criteria? Second type of decisions are the capital structure decisions. Once a firm has decided its investment profile, the mix of assets it will require, we need to focus on how to finance them. That is, how to raise the necessary amount of cash to carry these investments out. Basically, we could put in our own money. We can fund them with our own money, equity. Or we could go to the bank and request a loan, debt, or a mix of both. Key decisions, again, are risks, costs, what our providers of funds will require in return, what is the optimum debt and equity composition or mix. And the third type of decisions are the working capital decisions. By working capital, we refer to anything that is of a short-term nature, be it an asset or a liability that has an impact on our operating cash flows. Decisions such as how much money or cash do we need to have on hand to meet our upcoming payroll, our rentals, our payments to suppliers, our financial commitments. Also, how are we going to sell? On what terms are we going to sell our products? For cash, or are we going to extend credit? How much inventory, be it finished goods, be it raw materials, do we need to have to meet our customer demand or to complete our production schedules? How are we going to deal with our suppliers? Are we going to take advantage of supplier discounts? Well, all of these topics and more we will cover quite in depth throughout this course. But before actually diving into them, we will review certain fundamental tools that will help us understand and master these topics, such as financial analysis, time value of money, capital discounting techniques, among others. Finally, we will also address certain aspects that, for good or for bad, have become everyday topics such as mergers and acquisitions, financial distress and restructuring, and international corporate finance. And obviously, without forgetting to address the financial markets, where many of these decisions actually take place.